A retired school teacher named Margaret sits at her kitchen table in Lyon, France. It is November of 1918. The war is over. France has won. The streets are full of people crying and singing at the same time. Marguerite has 12,000 francs in a savings account at Credit Lyonnais. She earned it over 30 years of teaching. She thinks the hard part is over. She's wrong. Over the next 8 years, while France celebrates victory, while the politicians give speeches about reconstruction and glory, while the newspapers run headlines about reparations from Germany, Margaret's 12,000 francs loses 80% of its purchasing power. Not in a crash, not in a panic, quietly, invisibly. While everyone is looking at the victory parades, jump forward. London, 1946. Britain has just won the Second World War. Churchill is gone, but the empire is intact. The pound is the reserve currency of half the world. A retired civil servant named Harold has his life savings in British government bonds. He feels safe. He is wrong. Over the next 30 years, the pound loses 90% of its value against gold. Not because Britain loses a war, because the war cost more than anyone admitted while it was happening. Jump again. Washington, 2002. The September 11th attacks are a year in the past. The dollar is strong. The United States has just defeated the Taliban in 90 days. The headlines call it the unipolar moment. Americans with savings accounts feel safe. They are wrong. Over the next 6 years, the dollar loses 40% of its value against gold. Not because America loses, because the war cost more than anyone admitted while it was happening. Here is the thing that keeps me up at night. Right now, in March of 2026, the dollar is being held up by an Iran war premium. Gold and silver have just taken one of their sharpest corrections in years, and most people watching the markets are reading this as a signal that the dollar is fine and metals are overpriced. The historical record says something completely different. By the end of this video, you will understand exactly how the war premium works, which 4 positions survive when it fades, and which ones get destroyed. Every case, every time. Stick with me before we dive in. This is history, not financial advice. Do your own research. Now the pattern first. The war creates a premium. Fear flows into the dominant currency. Metals sell off on dollar strength. Everyone concludes the crisis favors paper over hard assets. Then the bills arrive. War costs money. Every modern conflict in the historical record ends with the country that fought it carrying more debt than when it started. That debt gets serviced one of 2 ways. You tax people, which is politically difficult, or you inflate the currency, which is invisible until it is not. Then the premium fades, the crisis resolves, or the market stops caring, or both. And the underlying fiscal damage, the deficits, the debts, the money creation reasserts itself without the fear trade covering it. The currency falls. Hard assets rise every single time. 1918, France wins the war. The franc holds during the conflict because war demand props it up. Then the bills arrive. France had borrowed massively from Britain and the United States to fight. Reconstruction costs pile on top. The government prints money to cover the gap. By 1926, the franc is worth 1/105th of its pre-war gold value. The people who watched France win the war and concluded the franc was safe lost 80% of their savings. The people who held gold Napoleons, the 20-franc gold coins that French peasants had been burying in their gardens for generations, preserved everything. 1945, Britain wins the war. The pound holds during the conflict because it is the empire's reserve currency. Then the bills arrive. Britain is functionally bankrupt. It owes the United States billions under the Lend-Lease settlement. The welfare state it builds after the war costs more than anyone projected. The pound is devalued in 1949, then again in 1967. By 1980, the pound has lost over 80% of its gold purchasing power since Victory Day. The people who held gold while celebrating Britain's finest hour preserved everything. The people who held gilts and savings accounts did not. 2001, America responds to September 11th with the largest military mobilization since Vietnam. The dollar surges during the initial conflict. Afghanistan falls in weeks. Iraq falls in weeks. Markets conclude the dollar is strong. Then the bills arrive. The Afghanistan and Iraq wars ultimately cost over $3 trillion. According to the Brown University Costs of War Project, The dollar index falls from 120 in 2000 to 72 by 2008. Gold goes from 250 an ounce to over 1,000. Same pattern, same sequence. Every single time the war ends, the premium fades, the debt remains. Now, what actually survives? Four positions documented. Number one is physical gold held outside the banking system. Here is what blows people's minds about the French case. The gold Napoleon, the 20-franc coin minted under Napoleon I, circulated for over a century, became the most important wealth preservation tool in France during the 1920s. Not because it was exotic, because it was physical and outside the system. French peasants and working-class families had a tradition stretching back to the Napoleonic Wars of keeping gold coins hidden at home rather than in banks. They were called bas de laine, the wool stockings, because that is literally where some of them were kept. Historians estimate that French households held more gold per capita than any other country in Europe. When the franc collapsed, those households preserved their wealth. The people who trusted the banks lost 80%. The people with wool stockings full of Napoleons did not lose a centime in real terms. And here is the specific documented outcome that almost nobody knows. When Raymond Poincaré stabilized the franc in 1926, repegging it to gold at 1 of 5 its pre-war value, the people who had held gold Napoleons through the entire crisis found themselves holding coins worth 5 times as many francs as when they started. They had not speculated. They had not traded. They had simply refused to hold paper while the paper was being destroyed. The stabilization that rescued France formally confirmed what the gold holders already knew. The paper had lost. The gold had won. The same sequence played out in Britain after the Second World War. The pound was devalued in 1949 from $4.86 to $2.80. The people who had exchanged pounds for gold sovereigns before the devaluation saw the sterling value of their gold jump overnight. The people who held pound notes and gilt-edged bonds saw their real wealth cut by almost 40% in a single weekend. One devaluation, one weekend, 40% gone. Today, the mechanism is identical. The dollar is currently at approximately 99 on the dollar index, down from a peak above 109 in January of 2025. The Iran war has added a temporary premium, but every element of the structural case for dollar weakness is still in place. Deficits above $2 trillion projected for 2026. Central banks in China, India, and Saudi Arabia methodically reducing dollar reserve holdings. The Fed holding rates while inflation runs above target. That is not a strong currency. That is a currency being propped up by fear. When the fear fades, the structural case reasserts. The people who held physical gold through the correction will be the ones who captured the next leg up. Number 2 is silver, but with a specific caution the history books miss. Silver outperformed gold in both the 1920s and the 1970s. In the French case, silver coins held their purchasing power alongside gold. In the U.S. case, silver went from under $2 an ounce in 1971 to $50 by 1980. The gains were larger than gold's, but silver is a dual-use metal. It has industrial demand as well as monetary demand. This means in a war-driven economic slowdown, when factories slow and industrial orders fall, silver can underperform gold in the early stages of a crisis. Right now, silver has corrected more sharply than gold from its highs, dropping from over $100 an ounce to below $70. That gap between gold and silver performance is historically the setup for silver's most explosive moves. When the war premium fades, when the dollar weakens, when industrial demand recovers, silver tends to catch up fast and then overshoot. The historical case in 1920, 1 year after France's victory celebrations, silver was already moving higher against the franc. By the time the franc hit its worst levels in 1926, silver in francs terms had outperformed savings accounts by a margin that most French families did not believe possible. The people who had inherited their grandmother's silver table settings found those to be more durable stores of wealth than the bonds their fathers had bought to fund the war. The British case after the Second World War tells the same story. In 1947, the British government quietly debased its silver coinage, replacing silver with cupro-nickel. The people who had been accumulating pre-1947 silver coins found themselves holding assets that appreciated steadily as the pound lost value year after year. The people who spent those coins as money lost the metal. The people who saved them held real value. And there is a structural floor under silver today that did not exist in any previous cycle. Every solar panel uses roughly 20 grams of silver. Global solar capacity is expanding at a pace that no previous generation of silver investors faced. The monetary case for silver is unchanged from 1920 or 1947. The industrial floor underneath it is new. When the war premium fades and the dollar weakens, that floor becomes a launch pad. If you are realizing that the assets that survive wars are never the ones governments tell you to hold while fighting them, pay close attention. This is about seeing the patterns before they repeat. Number 3 is productive land. This is the one that requires the longest time horizon, but has the best documented track record across every currency crisis in the historical record. In France after the First World War, agricultural land held its value in real terms, even as the franc collapsed. Farmers who owned land saw the nominal price of their output rise with inflation. Wheat, beef, vegetables, all priced higher in debased francs, while their land itself preserved capital. The real loss fell on the urban saver, not the landowner. The same pattern held in Britain after the Second World War. British farmland doubled in real terms between 1945 and 1970, while gilts lost 80% of their purchasing power. The mechanism is simple. Productive land generates income. That income reprices with inflation. The asset itself acts as a real store of value. No government in history has ever successfully inflated away the value of farmland over a full economic cycle. There is a specific French figure worth naming here. Charles de Gaulle's father, Henri de Gaulle, was a school teacher, the same profession as Margaret. He held most of his savings in land and gold rather than government bonds. When the franc collapsed in the 1920s, Henri de Gaulle's family was not destroyed. His colleagues who held bonds and savings accounts were. This was not prescience. It was a deeply French peasant tradition of not trusting paper that the urban professional class had abandoned. Today, productive farmland in the American Midwest is trading at historical highs in nominal terms, but priced in gold, it is still below its 1980 peak. If the dollar weakens as the war premium fades and the fiscal case says it must, farmland priced in weakening dollars continues to make sense as a long-duration holding. Number 4 is short-term fixed income repriced for inflation. This is the boring one. Margaret in Lyon held long-term French government bonds alongside her bank savings. Both were destroyed, but there was a small group of French investors in the early 1920s who held only very short-term instruments, bills that matured in 3 to 6 months and were continually rolled over at the new higher rates as inflation accelerated. They did not get rich, but they did not get wiped out. In an inflationary crisis driven by war debt, duration kills. Short-term paper that resets with rising rates survives. Long-term paper locked in at old rates does not. This is not an exciting position. But in 1922, France, boring survival was far better than exciting destruction. The modern equivalent is any instrument that resets frequently. Treasury bills, short-duration money market funds, not a path to wealth preservation, a path to staying liquid while hard assets do the heavy lifting. Now, what went to zero? Long-term government bonds. This is the lesson that keeps getting ignored. France issued rentes, perpetual government bonds to fund reconstruction after the First World War. French citizens bought them as patriotic duty. The government told them they were safe. By 1926, the real value of those rentes had been reduced by 80%. Holders did not lose their money in a crash. They lost it in the slow erosion that the government could deny was happening right up until it was undeniable. The parallel today? Any long-duration sovereign debt in a country running structural deficits financed by money creation. The mechanism is not dramatic. It is quiet. It is exactly what happened to Margaret. Bank savings accounts denominated in the currency being inflated. Margaret did not make a reckless decision. She saved for 30 years. She put her money where her government told her it was safe. She collected her interest every quarter. She was ruined by the same institution that told her she was safe. That is not a story about bad luck. That is a story about what happens to prudent savers when the system that protects paper wealth is the same system that created the debt that destroys it. The warning signs right now. The United States federal deficit is projected at nearly $2 trillion in 2026. That number was computed before the Iran military operation added its costs. Every additional week of conflict adds to that figure. The Brown University Costs of War project documented that the Afghanistan and Iraq wars ultimately cost the United States over $3 trillion, far more than any projection at the time of the initial operations. Iran will not be cheaper. The Federal Reserve held rates unchanged at its March 2026 meeting, not because inflation is beaten, but because the war has created a stagflationary bind. Raise rates and crush a weakening economy. Hold rates and let inflation run. The Fed chose to hold. The Frank story in the early 1920s is a documented case study in what happens when a central bank holds rates too low for too long after a war. The outcome was not immediate. It took 7 years from the armistice to the crisis of 1926, but it was mechanically inevitable. From the moment the war ended with the deficits unpaid, central banks globally bought more gold in 2024 and 2025 than in any 2-year period since the end of Bretton Woods. They did not stop when the Iran war started. They accelerated. These are not retail investors chasing momentum. These are sovereign institutions with access to treasury data, inflation projections, and reserve analysis that no public investor sees. They are doing exactly what the history of post-war currency says rational actors do when they know the bills are coming. They're getting out of the paper before the paper reprices. The pattern is visible if you are willing to look. The question is not whether the war premium will fade. Every premium in history has faded. The question is whether you will be positioned before Margaret realizes what happened to her savings or after. Because Margaret in Lyon in 1918 did not know she was living through a wealth transfer. She was celebrating. Her country had won. The future looked bright. The gold she did not buy in 1918 cost her everything she had saved over 30 years of teaching. The pattern is mathematical. The outcome is inevitable. The only variable is you. Now go diversify before you are forced to. If this history has changed the way you look at the currency in your wallet, please subscribe and like this video. We are unearthing the history they tried to bury. Plant the seeds for your future. The next treasury of knowledge will be open soon.